Hello, my name is Joshua Davenport, and I'll be doing a company analysis of TJX Companies Incorporated. TJX is an American-based department store corporation that has three main chain stores that include TJ Maxx, Marshalls, and Home Goods. It has more than 16,000 vendors worldwide. It operates in the United States with over 1,900 stores. The United Kingdom with 300, Ireland with 17, Germany with 63, and Poland with 21. TJX has reported a stable increase financially since the early 1990s and has continued this trend over the past few years like clockwork. Annual profit for TJX is $2.1 billion. Annual sales is $27.4 billion. Will steadily rise. TJX is projected to surpass its top competitor, Macy's, in annual sales by the end of the 2015 fiscal year. This is due in part by TJX's innovative buying strategy. They run a training program called the TJX University, where employees learn everything from handling themselves in the marketplace to the art of the deal. TJX training program rigorous because unlike traditional retail companies, buyers are handed a large quantity of money and are empowered to make decisions and large buys that in most companies would have to be approved by a board of executives. TJX buys inventory as needed while their peers buy inventory seasonally. The fact that buyers for TJX are able to buy so frequently allows them to buy the most in-style clothes and accessories. TJX has made amazing headway with opportunistic buying, which usually consists of closeouts, overruns, irregulars, and canceled orders by clothing retail companies. The strength of TJX is the fact that it is a safe, financially sound business. They have made a business strategy and have been executing it to perfection ever since. Their return on equity stands at 52.15%, which beats any of its top competitors by 10%. Their earnings per share, return on assets, net profit margin, and operating profit margins are all solid financial ratios, standing higher than their competitors or not far from the top. Another strength is that TJX reported improvement in its liquidity in year 2014. The company reported a current ratio of 1.66 as compared to 1.51 in 2013. The company's current assets continue to remain substantially higher than its current liabilities. In 2014, TJX's current assets stood at $6.068 million, whereas its current liabilities amounted to $3.518 million. As a result, the company reported a strong net working capital, which amounted to $2.55 million as compared to $1.951 million in 2013. This reflects an increase of 30.71%. Strong liquidity causes financial stability and helps the company meet its short-term obligations with ease. Also, another strength is TJX's debt-to-equity ratio, which is lower than any of its competitors, which shows a strong signs of future growth because of its lack of substantial debt. A weakness for TJX is that it limits its revenue opportunities by having its operations confined to the U.S. TJX companies bring up about 77% of its sales in the U.S. and the remaining 23% in Europe. Hence, the business operations of the company are primarily confined to the U.S., with a significant portion of its revenue coming from its domestic market, despite its presence in the Europe and Canada regions. Another weakness is the average retail company spends between 2 and 5% of its sales on advertising. However, TJX spends on average between 0.5 and 0.7% on advertising. So, how will TJX overcome its domesticated approach to business in the U.S. and begin to profit in the foreign market? And why does TJX spend so little on advertising? And how would it affect revenue and overall business if they allocated funds for advertising? And lastly, how will TJX meet its goals to overpass Macy's in revenue by the end of the fiscal year 2015? I have 3 strategies that TJX could pursue in order to increase future profits. Strategy number 1 is to remain with this tried and true method that TJX has been using for decades and slowly become a top retailer by relying on its own self-branding retailer, using discounted prices and low advertising costs, which in turn allows TJX to offer low prices on inventory while still maintaining a weak presence in the foreign market. Or strategy number 2, which entails strategy number 1. However, strategy number 2 has an emphasis on penetrating the foreign market by using merchants who are particularly suited for the particular regions that they will be stationed in. This does not at all affect the grand scheme of how TJX conducts its business, and the cost of this endeavor would be minimal. Strategy number 3 is my preferred strategy. It is quite simple. TJX is missing out on a substantial amount of profit in the foreign market. In order to capture this profit, TJX should allocate at least 3% of its sales revenue into advertising in order to better introduce itself into the foreign market. Advertising is a key component to retailing, and I think if TJX implements this simple strategy of more advertising, that it would kickstart profits in the foreign market, causing TJX to become a more global company. TJX's short-run objective is to surpass Macy's sales revenue in the 2015 fiscal year. To do this, the quickest and easiest way is to rely on strategy number 1, which includes relying on its own self-branding retailer, using discounted prices, and low advertising, which in turn allows TJX to offer low prices on inventory. However, corporations should think long term. The company should spend more money on advertising in the foreign market. If in the short term, TJX cannot surpass Macy's sales revenue, then they should spend more money on advertising, which in turn will show fruit in a profit margin. That's the end of my case analysis. Thank you very much.